Why your savings are trapped. The 2026 collapse versus 1929. In 1929, the collapse was loud. People screamed on trading floors. Banks shut their doors. Fortunes vanished in days. It was chaos you could see, fear you could touch, panic you could hear in the streets. But what if the next collapse doesn't look like that at all? What if in 2026, your savings don't disappear overnight? They just slowly lose power. No dramatic headlines. No lines outside banks. No market crashing 90% in a week. Just rising debt, silent inflation, controlled markets, and a financial system so engineered that it prevents free fall but traps your money in place. Back then, the crash of 1929 led to the Great Depression. Today, the system is bigger, more digital, more interconnected, and far more managed. Institutions like the Federal Reserve didn't exist in their modern form during the early years of the crisis. 1. The illusion of wealth versus real liquidity. In 1929, the bubble was visible. The stock market had surged dramatically before the crash of October 1929. When panic hit, prices collapsed rapidly. Wealth evaporated almost overnight. In 2026, the bubble isn't just in stocks, it's everywhere. Real estate, tech equities, private markets, even government bonds have been inflated by years of ultra-low interest rates and stimulus policies following the 2008 crisis and the pandemic-era interventions. The key difference? In 1929, wealth disappeared because asset prices crashed. In 2026, wealth may be trapped because asset prices are artificially supported. Central banks learn from history. Institutions like the Federal Reserve and the European Central Bank no longer allow uncontrolled collapses easily. Instead, they inject liquidity, buy bonds, and manage perception. But liquidity support doesn't create real economic productivity. It creates dependency. When central banks hold massive portions of bond markets, price discovery weakens. Your savings, especially if tied to pension funds or bond-heavy portfolios, become exposed to slow erosion rather than sudden collapse. 2. Bank runs then versus digital restrictions now. In 1929 and the early 1930s, people physically ran to banks to withdraw their money. Thousands of banks failed across the United States. Depositors lost everything. Today, we don't need lines around buildings. Banking is digital. Your account exists as numbers on a screen. That seems safer, but it also means control is centralized. During modern financial crises, capital controls can freeze withdrawals, limit transfers, or restrict international movement of funds. We've seen smaller examples globally in recent years. The infrastructure exists. 3. Debt levels, then versus now, before 1929, leverage in the stock market was extreme, but overall global sovereign debt levels were nowhere near what they are today. In 2026, governments worldwide carry unprecedented debt burdens. The United States alone operates with multi-trillion-dollar annual deficits, while global sovereign debt has surpassed historic highs relative to GDP. High debt creates fragility. When interest rates rise, servicing that debt becomes more expensive. Governments then face 3 options: raise taxes, cut spending, inflate the currency. Historically, inflation is the quiet solution. Unlike 1929's deflationary collapse, where prices fell sharply, modern policymakers fear deflation more than inflation. Why? Because deflation increases the real burden of debt. So instead of a Great Depression-style crash, the 2026 risk is prolonged currency devaluation. Your savings remain in your account, but their purchasing power shrinks. That's a different kind of collapse. 4. Stock market mania. 1929 versus AI and tech euphoria. In the late 1920s, radio stocks and industrial giants fueled speculative mania. People believed a new era had begun. Sound familiar? In the mid-2020s, artificial intelligence, automation, and mega-cap technology companies have driven massive valuation surges. The difference is scale. Today, a handful of companies dominate global indices. Back then, investors borrowed to buy stocks on margin. Today, passive investing and index concentration creates systemic exposure. If a few large companies stumble, retirement funds, ETFs, and pension plans worldwide feel it instantly. 5. The middle class squeeze. The Great Depression devastated employment. Unemployment in the U.S. surged above 20%. Savings were wiped out not just by banks failing, but by income disappearing. In 2026, unemployment may not spike dramatically at first. Instead, the squeeze comes from stagnant wages and rising costs: housing, healthcare, food, energy. Inflation acts like a silent tax. Unlike 1929, where collapse was violent and obvious, modern economic stress is gradual. 6. Government intervention, Hoover versus modern policy. In 1929, policy responses were slower and more fragmented. Herbert Hoover initially resisted aggressive federal intervention, believing markets would self-correct. It wasn't until Franklin D. Roosevelt launched the New Deal that large-scale structural reform and federal relief programs reshaped the economy. Today, governments move instantly. Central banks inject liquidity within days, sometimes hours, to prevent panic from spreading. This rapid response lowers the odds of a pure 1929-style collapse. 7. Psychological panic versus psychological paralysis. In 1929, fear drove immediate action. Investors sold. Depositors withdrew funds. Panic was visible. In 2026, the greater risk is paralysis. People assume central banks will always step in. Markets drop, then rebound. This pattern has conditioned investors to buy the dip. But if inflation persists or growth slows simultaneously, a stagflation scenario, central banks face a dilemma. Raise rates to fight inflation and risk recession, or cut rates and fuel more inflation. Either choice pressures savings. Unlike 1929, where wealth destruction was rapid and shocking, the modern collapse could be drawn out. A decade of low real returns, negative real interest rates, and currency erosion can quietly destroy purchasing power. No dramatic crash, just diminished futures. But every intervention shifts risk somewhere else, often onto savers. Your future isn't threatened by a dramatic implosion. It's threatened by silent erosion. So the real question isn't whether history will repeat 1929. It's whether you can recognize a modern collapse that doesn't look like one until a decade later. You realize your savings were never destroyed, just quietly diminished. And by then, reacting may be much harder than preparing. Let us know in the comments what you think about why your savings are trapped. The 2026 collapse versus 1929. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.